Please, a very big round of applause for Sir Howard Davies.
Well, thank you very much, Tim, for that introduction, and good morning, ladies and gentlemen. I am, however, going to disappoint him and you by not talking about RBS. I will become chairman on the 1st of September, and I think probably we'd all agree that the last thing they need is two chairmen to add to all their other problems at the same time. So I think I'll duck that one, if I don't mind. Tim, however, did, rather tactlessly, I felt, point out that the true value of conferences like this lies in the coffee breaks and the tea breaks and the conversations you have among yourselves, and therefore that the speakers are merely trying to fill the gap between tea and coffee. So I thought that was pretty tactless, not a good introduction to your speaker, but I'll do what I can. He also said something that I have to say I question: you always want your children to be in better shape than you are. This is not true in my case. I still play squash against my two sons, and I constantly encourage them to eat unhealthily and drink too much to give me just a chance of beating them occasionally, which doesn't now happen very often. I also labour under the particular problem of having one of my sons who is at McKinsey, and I was at the early stage of my career, and who constantly comes with questions like, when did you get promoted to be senior engagement manager? And then he ticks this off and tells me he got it 9 months before I did in 1981. And so this kind of competition with your children, I'm afraid you touched a raw nerve when you mentioned that this morning. But what I'm going to do is to talk about the macro prospect. I'm going to talk a bit about the global prospect and then about the UK. I will say a little bit about the Eurozone, but I know that Norman Lamont, who has particular views about the Eurozone, but is very well informed on it, is going to come and talk to you later. So I hope not to trespass too much into his territory. I have to say that I'm pleased that you're still interested in the macroeconomy. Most of the people I talk to at the moment, all they want to talk about is the election. And even though the campaign hasn't started, I'm bored with it already. But I will say a little bit about the political prospect, because I think that is feeding back into the economy in one or two interesting ways. So, as I say, I'll talk a bit about the global side and then the UK picture. The UK, of course, being a very open economy, is a good perspective, and some of the detail about the UK does also tell you something about what's happening in the rest of the world. And then I will end with just a few brief comments about the financial regulatory scene, which I was also asked to do, but I'll cover that relatively briefly, but very happy to take questions on it when we get to that point. If you look at where the IMF thinks we are, this is their most recent World Economic Outlook, published around the end of January, and their view, as you see at the left, is that the global economy will grow overall a little bit more rapidly than last year, and they expect next year to be even better. This is in part driven by the oil price, which overall gives a boost to growth. Of course, there are oil producers whose services will decline, but on the whole, those countries have a lesser propensity to spend than the oil consumers, and therefore, if you have a surplus transferred from oil producers to oil consumers, you typically will see a pickup in global consumption and global growth. But if you look at the advanced economies, the IMF is forecasting a flat picture between 15 and 16, with growth rates not that bad at 2.4%, obviously distributed such that it's more in the US and in the UK than in the Eurozone or Japan. But not a very, very exciting prospect. But emerging markets, which are slipping back a little bit this year, they see picking up next year. So the global picture, as seen by the fund, is of reasonably steady expansion, though of course not at the rates we saw up to the financial crisis, when the world economy was growing on average by somewhat over 4% a year for quite a long period of time. Now, within that context, what about the UK? Well, this is what the Bank of England see. As you know, the Bank of England love fan charts. They can turn almost any figure into a fan chart, and this is where they see the economy growing here. The National Office of National Statistics data is the hard line on the left of the chart, which is what has happened, or what they think has happened. Of course, those figures very frequently get revised one way or another. And the bank is looking over the next 3 to 4 years at a growth projection centred on between 2 and 3%. So that's the dark shaded part. So they are reasonably optimistic. This would mean the UK returning to, broadly speaking, its trend growth rate before the crisis of somewhere around 2 to 2.25%. Now, they do point out that just recently growth has slowed a bit. I don't ascribe a huge significance to that, because I think that in the early part of 2014 we were seeing a bounce, and possibly, when the economy at one point was growing at 3.5%, which, given the global background, particularly what's going on in Europe, that looked difficult to sustain. So I don't ascribe a lot of significance to the fact that the growth rate in Q4 slipped back a little bit. What is interesting, though, in the UK, and in some ways slightly depressing from the government's perspective, is that essentially we have once again seen a service sector-led recovery. This measures progress in the economy back to the first quarter of 2008, just before the economy started to pitch downhill rapidly. So Q1 2008 is 100, and you can see that the service sector has grown to about 108, so it's well above what it was in the pre-crisis peak. GDP now above its 2 at 103%, but manufacturing, the dark blue line, is still at only about 94%. So we have not seen any real evidence of George Osborne's March of the Manufacturers, which he proclaimed was going to be his objective of policy. In my view, this is not very surprising. It is very difficult, if you look through economic history, to find examples of countries which lose their manufacturing base and then recover it on a large scale, aside from the particular cases of Germany in the 2 World Wars, and Japan as well after the Second World War. And I find it very unlikely that we will see manufacturing in this country growing more rapidly than the service sector. That is the sort of economy we have. So I'm not too depressed about it, as long as we have a lot of traded services, but at the moment you can see that that's not working out terribly well when I come to talk about the balance of payments. But what we see is a normal UK service-led recovery, with financial services actually picking up now, but also other business services in London. The cultural economy has done particularly well. Higher education, which I used to be in, has done very well. These are the businesses that are actually driving growth forward at the moment in the UK. Manufacturing has stabilised, picked back a little bit, and there are some shining examples like Jaguar Land Rover. Our transport equipment exports are up 35% over the last 3 years. So there are some bits that are terrific, and who would wish to decry them? But overall, I'm afraid it is not happening. The rebalancing that the government wants to see is not occurring on any scale at all. If you look at what has been driving growth, if you look at it from a financial point of view, well, I'm afraid a lot of it has been consumer spending, driven by the fact that the savings ratio fell back. The bottom one is probably the best line to look at, because that is savings apart from employer-related pension schemes. So the top line takes account of the fact that some people are forced savers, if you like, through employer pension schemes of one kind or another. But if you look at the discretionary spending, which is the bottom line, as we saw, the savings ratio went significantly negative up to the crisis. People were spending money they didn't have. Then the crisis showed that line march upwards as people realised that they were overgeared and decided to save. But what's now happened is that very British people have gone back to spending again. And that's been what has been driving the recovery. The savings ratio is now back to below zero. There is dis-saving by households, which is, well, I suppose that's okay up to a certain point, but I think we might hope that the savings ratio does not fall back to where it was in 06-07, which we discovered was an unsustainable position. So this is a line that needs, I think, watching carefully. And it's happened. Well, it's a coincident indicator, if you like, but consumer confidence is strong. It picked up very sharply beginning in the spring of 2013, and now people are pretty confident about the future. This is a very simple question. Are you confident about a financial future for yourself and your families? And people are now pretty confident of that, and that hasn't really changed very much. So we've got consumer confidence good, we've got consumer spending has picked up, but we do have weaknesses, particularly in the construction sector. And this, of course, relates also to what's been happening to house prices. Until very recently, house prices have just flattened off, but we've had a big boom in house prices in London, as you all know. And this is partly because house construction is still very weak. We are only building 130,000 houses a year in this country. And if you think we have 25 million households, that means you would take 200 years to build a housing stock. Now, it so happens that I do live in Dorset in a house that is 430 years old, but not that many people do live in houses that are more than 200 years old. And so that is the rate at which we are replacing our housing stock, which is clearly absurd. I mean, we must be trying to build more housing than that, of course, and that doesn't even take account of the fact that the population is rising for two reasons. One, net migration, which we know, in spite of the government's best efforts, is going up. But secondly, household size is falling because fewer people getting married or getting married later, or older people living alone longer. So the household size is falling, which means the average number of households you need, of houses you need, is going up. And we are simply not keeping pace. This, in my view, is a very serious problem for the country, and one which at the moment it's very difficult to be optimistic about. The housing completions line, that's the sort of pink line in the middle, is 30,000 a quarter. It's actually just about 130,000 in the last year, which is clearly, for a country of 60 million people, clearly completely inadequate. Something has to be done there. It points, of course, to a significant reform we need in our planning rules, because the builders will tell you that there isn't the land available. That would take us off in a different direction, but it is a significant weakness. Investment has picked up somewhat. I mean, this is the total investment line. We saw an absolute collapse in investment in 08-09. Not surprisingly, in that kind of recession, firms will cut back on what they can cut back on quickly, which is investment projects. And then things have picked up reasonably healthily. The green line is one to look at, because that is described inelegantly as other, but essentially it means business investment apart from oil, electricity, gas and water. And of course the oil cycle is rather volatile, and oil is now negative as an impact on investment, not surprisingly given where the oil price is. But our investment, business investment, has picked up reasonably, although it's still not probably high enough to compensate for the removal of capacity we saw in the last recession. The real problem for the UK, which is partly, of course, because we live in a bad neighbourhood, is that our foreign exchange position is poor. Now, this is looking at it in a financial way. So the blue line is the rest of the world's surplus with us, if you see what I mean. That is what we are paying the rest of the world, which is 6% of GDP. So there's a net outflow of funds. The government is still borrowing, of course, as we know, although the bottom line shows the government's borrowing has been falling because that's the government's financial deficit has been narrowing, but our deficit with the rest of the world has been going up sharply. And in fact, the UK's current account deficit was at a record high last year in the third quarter. And this is driven by a number of factors. One, of course, as I explained, consumer spending has been rising more rapidly here than in most of our trading partners, certainly more rapidly than in any of our European trading partners. So we've had domestic consumer spending rising. We've had a slow pickup in investment, so we lost a lot of capacity in the recession. So as our consumer spending rises, what do we buy? Well, we suck in imports because our domestic production is overall not large enough to cope with that increase in demand. And of course, we have had a significant appreciation of the exchange rate, particularly against the euro, where we're now at 130 something against the euro, where only 18 months ago we were down at 115. The Eurozone is doing what it needs to do, if you like. Its devaluation of the Eurozone is now at last beginning to show through in a modest improvement in the economic prospect on the other side of the channel, where we're now seeing positive growth rates in almost all of the Eurozone countries, still well below trend, but nonetheless a bit better than 6 months ago. Quite a bit of that, I think, driven by the depreciation of the euro against the dollar and the yen, but also against sterling. This, I think, is not a great position to be in. It's not something the Chancellor will talk a lot about in the run-up to the election, I expect, because you have to say we are currently heavily dependent on flows of capital into the country, and that has been driving up the exchange rate, and that does not look to me to be a sustainable position. I cannot see that we're going to be able to run a 6% trade deficit on a continuous basis. Now, looking more at the good news, well, unemployment has fallen, and people have been somewhat surprised at this, and indeed I would not have expected unemployment to fall as rapidly as it has done. There's a good news bit about this, which is we do seem in this recovery to be benefiting from the fact that our labour market is much more flexible than the labour markets in continental Europe, where people are still very, very reluctant to hire. So even as the economy has picked up a bit, in France, say, where I spend a certain amount of my time now teaching, the impact of a modest recovery has not been seen at all in a reduction in unemployment. Unemployment is continuing to rise because firms are very, very keen to avoid hiring people until they absolutely have to, because of the high costs of hiring and the high cost of firing. So when you make your labour market inflexible, you have high minimum wages and very high degrees of employment protection, then people do not hire when the economy picks up until they absolutely have to. So whereas in our case, employment growth has actually gone kind of almost ahead of economic growth, in most of continental Europe, employment growth lags economic growth, because people are reluctant to hire. So this is, on the whole, a good story. Of course, the bad side of it has been, and this is the thing that Miliband has banged on about, although perhaps you'll have to do so a little bit less after the latest figures, that wage growth has not picked up. But if you ask me to tick a box as would I like to have more employment and wages flat or increasing unemployment, I think I choose the first box, frankly. It may seem harsh to the people in work, but on the whole, I think our labour market works more effectively. We saw the figures produced by the Institute of Fiscal Study this morning to suggest that employment, that wages have now got back to the level just before the recession, for all except the 20s to 30s, so everybody else is now at least as well off as they were before. This has taken some time to pick up, but the good bit has been that we have seen unemployment falling quite sharply, which for a number of social reasons I think is rather a good thing. And the Bank of England expect unemployment to continue to fall and to be centred on, their expectations centred on around 5%, which in a fast-moving economy, well, people argue what is full employment these days. We used to think of it as being 2%. I think people now would more say 4 to 5% is likely to be more or less full employment, given the transitional moves in the labour market, which are now more rapid than they used to be. So the employment picture is pretty good. Now again, the other side of that is that productivity has not been great. And of course, one of the sides, the fact that the labour market is fairly flexible and people take people on when they see any demand, we have seen relatively flat productivity in the UK. But actually, we may be beating ourselves up a bit too much about that, because in fact, for the big European countries, this shows you Germany, the lines are so close together, so you can't really distinguish them terribly well, but that's the point. The point is that the lines are relatively close together. That our experience on productivity has not been very much different from the German experience or the French experience. Spain and the US have shown much better increases in productivity. Spain, however, of course, still with 20% unemployment, so it's not such a healthy picture in Spain. The US does appear, once again, to have shown the dynamism built on high investment in innovation, a more effective use of IT in the US, typically. And so their productivity performance has been good. But ours has been kind of in the pack with France and Germany. So it isn't, I think, that if you have a better employment performance, you necessarily get worse productivity. There's not a lot in it. So our labour market is working better. Inflation, well, inflation is at the moment still yesterday's problem. Deflation is more of an issue. This is what's been happening in the UK. The Bank of England do expect inflation to pick up, but still to be comfortably centred on their 2% range. And in other parts of Europe, of course, the big issue still remains deflation. This takes us into some interesting arguments about whether central banks really can engineer an increase in the price level, as they're being told to do in Japan. Quantitative easing may deliver that, but it hasn't done so yet here. But for the moment, particularly given what's been happening on the oil price, I don't think inflation is a very serious worry. Now, at some point, monetarists will tell you that if you keep on increasing the money supply through quantitative easing, eventually this may feed through, but I think eventually may still be quite some time yet. And of course, the central banks do have the possibility of mopping up some of this liquidity if they need to do so. So inflation does not seem to be a particularly menacing cloud on the horizon. One thing that is on our horizon, and which is causing some anxiety in the economy, is, of course, the election. Very difficult to read. The polls will tell you very different things. This is the YouGov poll, which tells you that Labour is still slightly ahead of the Conservatives, with UKIP still at 15%, and amazingly, the Greens at 7%. I would recommend, if anybody likes reading fiction, to read the Green Party's manifesto. And then you really do wonder about the sanity of the 70% of people. I mean, they want to abolish money. That's a start. No central bank. The amount of money determined would be a sort of committee would decide how much money we need in the economy. I mean, it is quite an extraordinary document. I have to say, I say this slightly disappointedly because I'm kind of, on a kind of green to black spectrum. I'm fairly greenish actually, but I thought of the Greens as being a kind of environmental pressure group, if you like, trying to keep our politicians, committed to some of these important environmental things like climate change. But actually, it's not that at all. It's a complete message from Planet Zog. I mean, it really is worth it's worth a look. But that's where the YouGov tell you, but then the ICL, not a perfectly respectable polling organisation, tells you completely the opposite thing at the moment. That the Conservatives are actually picking up. This is just last week, and I don't know. It's very difficult to tell. But the one thing that does appear to be true is that the prospect of a decisive government with an overall majority looks pretty certain. It looks as though we're going to have some kind of coalition. And I think this is beginning, there's probably only anecdotal evidence for this at the moment, to cause firms some anxiety. And there's definitely a feeling that there might be a lot of decisions gummed up. I'm involved in one, but may well be in that category because, as you may know, I'm chairing the Airports Commission for the government at the moment, trying to produce a recommendation on where we should have increased airport capacity. And of course what preoccupies me is, will I have a government to whom I can deliver this report? I'm sure there will be a report, we're well on track to publish it, but I still have to put to whom it may concern on the envelope and send it off, because, and I think big things like that may be, and HS2 of course is in that category, that may be very difficult in an environment in which there is a coalition. On the whole, I'm quite in favour of the idea of a minority government that can't pass much legislation, because it seems to me we've got too much of it. But nonetheless, for some of these big projects, which are kind of touchstone indicators of a country's willingness to make big decisions to invest in the future, that's going to be very difficult after the election if we have an unstable coalition or one without much of a majority. So that, I think, is a big potential negative factor over our economy. But returning to the overall picture at the global level, well, what we've had is, in some ways, a benign position. We've had surplus oil production driving down the oil price, which has resulted in an improved growth performance, particularly in the US, but in fact, in some others now starting to pick up as well. We've had the euro and the yen depreciating against the US dollar, which is probably sensible given the economic position that they are in, and we're starting to see a bit of impact on that. We've seen emerging markets with risk spreads going up, which has reflected some uncertainty about their prospect, particularly in a low commodity price environment. And if you look then, this is the IMF's view of the risks. Well, the upside, we still have lower oil prices, which is in fact driving consumption and driving growth, with, on the downside, some market volatility, which has been pretty high, interest rate volatility, currency volatility has been high, still low investment, we've seen that in the UK, still stagnation in Euro area and Japan, although, as I say, most recent figures suggest that there may be just a few grounds for optimism there, and of course, enough geopolitical risks to occupy us for the rest of the day if we wanted to go through the Ukraine and the Middle East and what's happening in the Baltics and goodness knows where. So a lot of geopolitical risks. But overall, my view is, to go back to where I started, that this will net out at a modestly optimistic prospect for the next year or two. Not back to growth rates before the recession, but still in the 3.5% territory for the world as a whole. Let me just finally say a word or two on the financial regulation front. I think many of us would have hoped that in 2015 we would have been the other side of reforms in financial regulation following the crisis. Few of us would disagree with the idea that from what the experience of the 2007 to 9, that there needed to be an overhaul of financial regulation. But I think most of us would have expected it to have finished by 2015. That does not seem to be the case. The mood still seems to me to be to increase capital requirements, also to pursue a lot of post-crisis litigation, which is proving very costly for our banks, and also to spread the benefits, I say in inverted commas, of financial regulation to other areas. So we've got globally significant insurance companies designated by the Financial Stability Board and with additional capital on them. We have now something which glorifies the name of the NBNIGSIFI program, which is the non-bank, non-insurer, globally significant international financial institution. That's code for Blackstone, actually. With attempts to bring some of these big asset managers into the regulatory net. And unfortunately, I see no sign of a diminution of this activity. If I may end finally with a shameless piece of marketing. I've just written a book about this, which we published last Friday, called Can Financial Markets Be Controlled?, which is an essay on the way in which we've achieved we've moved to a new position of regulation, which I think is currently an unstable balance. I think the regulators are now promising too much in terms of the way they can think that they can control the financial system, and not just the traditionally regulated clearing bank bits of it, which of course need some regulation. So I think we're still in the position where regulation is tightening, where financial activity is going to be more constrained, and I think that is a factor, particularly in Europe, which is still holding back the recovery, because credit, in spite of the fact we've got zero interest rates, actual credit for firms is still quite constrained, because the banking system is still having to rebuild its capital and achieve ever higher levels of capital. And you can only do that in one of two ways: by persuading the market to give you more capital, which they're not terribly keen to do, or by constraining the growth in your balance sheet. So that's what's been happening. So financial regulation remains, I think, an area of concern, which is tending to hold back the recovery. But I don't have time, I think, to go into the detail of that. So I hope that has given you some food for thought at the beginning of what I'm sure will be a very interesting day. Thank you for your attention.
So Howard Davies there. Well, listen, we've got 5 minutes of time for questions for Sir Howard. I just briefly wanted to ask him about regulation. I think I read a couple of weeks ago that HSBC is now spending a third more on dealing with regulation in 1 year. That was from 2013 to 2014, I think. Are we going to see more of that? And is that inevitably going to have a cramping down effect on bank credit that they can offer us?
Well, unfortunately, I think we are, because one of the difficulties is that banks have discovered that they've got a lot more regulators than they ever thought they had. So if you were a bank in the US before, or in the UK, you knew that you had the Fed, and you knew that you had, whether it was the FSA or the Bank of England, that was your regulator. But now you discover that actually you have a lot of other regulators, like the Department of Justice, like the Attorneys General of the different states. Of course, in the UK, we've now got the FCA, which are also discovering that the tax authorities are interested, the anti-money laundering people, the police frequently. There's a whole raft of what you might call regulation, but isn't the regulation in the sense that we used to think of it, that a bank would have a prudential regulator that would look at its capital. But now there are all kinds of different expectations on banks, which I think they didn't have before. We didn't used to think that the banks were tax collectors, actually. But now that's the expectation, I think. So I'm afraid, I think it's not surprising that HSBC have massively increased their regulatory staff. The bank I'm currently on the board of, especially the one I'm going to chair, is Morgan Stanley in the US, and I think exactly the same would be true. and possibly more so.
This gentleman here has got a question. Give us your name and title if you wish to.
Thanks very much. Ian today from Grosvenor State. Thank you very much for that talk, Sir Howard. Listening to that, it sounds as though everything in the garden is quite rosy. The outlook sounds relatively benign. Speaking as an asset allocator at the moment, I'm struggling to find assets which represent good value. We've got equity markets in the UK and the US bumping up against all-time highs. Bond yields near all-time lows. I think a month ago they probably were at all-time lows. And yet at the same time, volatility, and here I'm going to disagree with you, the VIX is at about 13 at the moment, compared to an all-time low of just over 10. So in other words, still at a pretty low level, which gives the implication that there's scarcely a cloud in the sky. But when one looks at the geopolitical situation in Ukraine, Middle East, South China Sea, East China Sea, appears not to be the case. The only thing that I can find at the moment that's cheap seems to be the price of volatility. And one thing that you didn't really touch on was debt. And since 2007, the figures I've seen show that debt has been increasing since the start of the financial crisis. I think it's increased at the rate of something globally, something like 5.3% per annum against the sort of GDP growth rates that you've been showing us on the screen of 3% or so. In other words, we haven't been deleveraging at all, we've been re-leveraging. Are we living in a false paralysis here?
I know the figures you're talking about because there's a McKinsey report on debt and deleveraging, which actually I was with one of the team on as one of the advisors on that project, and that is certainly true. I don't think I intended to give you a picture that wasn't totally benign, because I did point out that certainly in the UK, I think we have an unstable current account position. I think we are, I personally am rather anxious about that. And I don't think that we are going to return to the growth rates pre-crisis whilst we still have this large debt overhang. But of course we have very low interest rates, and it's not surprising if you have a very low interest rate environment that you still had increases in debt, because in spite of the sort of pressures to deleverage, debt has been very, very cheap. So people have gone for it. As for where you might invest, well, I suppose it's not an original observation, but QE has been terrific for the equity markets in the US and the UK, and I can't see why it wouldn't be in continental Europe. I think if the ECB carry on with the programme as they've set out, that's going to be a very pro-cyclical programme, because the economy has just started to pick up as they start. As we all know, they should be doing this 2 years ago, really. But I think that it looks likely that that will have a positive impact on European equity markets. And of course, what I showed you on property, the fact that we just aren't building enough, suggests prices are going to rise there as well.
Okay. Well, you know what? We've done one of those things of running out of time, but I think, Sir Howard, you're around for a little while, aren't you? If anyone wants to talk to you face to face, please a big round of applause for Sir Howard Davies.